Good morning. My name is Frank Grinnell. I've been advising professional money managers and investing in the stock market for over 20 years. It serves as my day job, but most importantly, it is my absolute passion. On Street Views, I offer my daily viewpoint on the stock market in under 7 minutes. I will cover things like the global macroeconomic picture, the mood of the market, company-specific news, secular trends with some actionable sector and stock calls. I hope my insights are useful to you, whether you are a professional money manager or a passionate investor. At Grinnell Capital, we actively manage dynamic stock and ETF models for financial professionals and their clients, as well as individual investors. If you want to learn more about what we do, send me a note, frank@grinnellcapital.com. You can also find more of my insights on Twitter @GrinnellFrank. And now, today's Street Views. All right, happy Tuesday, PPI day, 15th of November 2022. PPI up 0.2 versus up 0.4 month on month, so cooler than expectations there. Ex-food and energy, zero. And on a year over year, 8% versus 8.3 expected. So cooler across the board for PPI, and there actually were some downward revisions to prior months, so definitely constructive on that data. 10-year yield looking 378 right now, 378, 379, so that continues to fall off on the yield. The thought that the highs on the 10-year are potentially in when it comes to a yield basis, getting more credence. Triple Q's up almost 3%. Dollar continues its slide, which will bid all the non-profitable tech stuff. Probably need to lead to another round of short covering. Could be another big day out there. Walmart, better numbers. We talked about this potential a little while ago. You'll probably recall this. 56% of their sales are groceries these days. So you got the trade down effect. You got more wealthy people, relatives shopping there versus other places. They do drive the cheap prices. Now it's a big stock buyback. We are long Walmart. It's up on the upper 25% of holdings. Taiwan Semi. Podcast listeners, you will recall last week after the Global Foundry earnings release, we did talk about TSM being a superior foundry. We did talk about them as having pretty much gone down every day since mid-August at that point. We spoke of the forward PE around 11 times and did see some insulation there relative to other areas of semiconductors in the market. We did buy some just under $73 a couple days ago. Just I think on Friday actually we bought some just to get involved. Just kind of a one-third position. See how we do. See what happens. Hopefully you did too. Obviously the 13F filings reveal that Berkshire Hathaway bought a lot more than I did in Q3. They put $4 billion into this thing. Their biggest outright purchase. Stock looking up. Every time I look, it's up a little higher. It was up like 12% last I checked. Would not chase, but nevertheless, keep an eye on it. I think a lot of the down underperformance of TSM is due to the China risk, and maybe that's cooling off a little bit. I don't know. Maybe Biden and Xi are finding a little kumbaya. It seems like there's some good sentiment anyway. Yesterday we gave you levels to watch for. We could see 4150 on the S&P. We're going to gap up over 4,000 this morning. The Russell's going to gap up over its 200-day moving average. So the SMHs, the semis, are going to be right at their 200-day on the open. Either this rally is about to stall out like real quick, or we could run a little bit further. It seems like the little bit further camp would be intact. Along that, ways to play. I mean, emerging markets, I think, still look interesting. When you have that falling dollar, that's always been kind of the big catalyst. Once the dollar starts to really break, and it looks like it's heading toward its 200-day moving average, you'll see what happens there. But we own EWH. We own Hong Kong. We've owned that for a little bit now. That's looking up again this morning. It's been a fantastic play near term. We recently bought ECNS, Edward, Charlie, Nancy, Sam, as a way to play their ETFs for small caps in China. Not a ton of these out there. This one seemed relatively reasonable on an expense basis. Liquidity is not great, so we have to buy it in small little chunks. But You will recall that I talked about Matthew's Asia being at Schwab Impact a couple of weeks ago. Very positive comments on small caps in China. I think it seemed like they thought that was the biggest opportunity. Falling dollar, huge tailwind for emerging markets. Another one might be, so we might add the EMXC, emerging markets ex China, since we've got small caps in China, and the EWH. We might go tack on that EMXC to play the rest of it. Good chance we do that. Not there yet. So good luck out there. Have fun. Enjoy it. And be smart.
And now for some important disclosures. Grinnell Capital is a state-registered investment advisor. Services offered by Grinnell Capital can only be offered in certain states where Grinnell Capital is registered or meets required exemptions. Registration does not imply a certain level of skill or training. For additional information about Grinnell Capital, including its services and fees, please review the firm's disclosure statement as set forth on Form ADV and available at no charge at advisorinfo.sec.gov. This podcast is provided for informational purposes only. The information contained herein should not be construed at the provision of personalized advice and is subject to change without notice. This material should not be considered as a solicitation to buy or sell any asset or engage in a particular investment strategy. Investing in securities involves the risk of loss, including loss of principal invested, and may not be suitable for all investors. Past performance is no guarantee of future results. This podcast contains certain forward-looking statements which indicate future possibilities. Actual results may differ materially from the expectations portrayed in such forward-looking statements. As such, there is no guarantee that any views and opinions expressed will come to pass. All expressions of opinion reflect the judgment of Grinnell Capital as of the date of publication and are subject to change without prior notice. This podcast contains information derived from third-party sources. Although we believe these sources to be reliable, we make no representations as to the accuracy of any information prepared by any unaffiliated third party incorporated herein and take no responsibility therefore. This podcast is provided with the understanding that Grinnell Capital is not engaging in rendering legal, accounting, or tax services, and we recommend that you seek out the services of professionals in these aforementioned areas. The principal investment focus of the accelerator model, the strategy, is to achieve strong relative and risk-adjusted returns, primarily by investing and trading in securities issued by companies that focus on the global information, technology, consumer, healthcare, industrial, and infrastructure sectors. These sectors are characterized by robust secular growth, an abundance of both new and maturing product cycles, a high degree of competition that creates the potential for relative winners and losers within a subsector or theme, a high degree of revenues and earnings volatility, rapidly changing sentiment and public perception, significant yet unrealized potential for globalization, and superior relative liquidity. Investment in the strategy is speculative and involves a high degree of risk. The second investment model is called the ignition model. The ignition model is an all-exchange-traded fund, ETF, strategy with investment objectives similar to the accelerator model. This model seeks to capitalize on long-term growth trends experienced by the market leaders in various areas and sectors. The ignition model will also seek ETF investments based on cyclical forces experienced in the U.S. and the global economy. This model is also designed to have the ability to offer some downside protection in the event of significant market stress through investments in ETFs designed to take advantage of market volatility. The strategy's performance can be volatile. Grinnell Capital has total trading authority over the strategy. The use of a single manager applying similar trading programs can mean a lack of diversification and consequently higher risk. For more important disclaimers, please visit our website, grinnellcapital.com.